Welcome everyone to the session. So here we're going to discuss about the financial planning and the life cycle of a human being and how we can effectively plan our life with the financial freedom and reach our goals with the peace. Look at the images shown in this slide. You're able to see like our initial 25 years we spend most of our time in the schools and colleges to get a degree, and after that we get into a job and we're going to spend around next 30 years to 35 years in our earning potential. And later point we get a retirement and we maybe biologically we can't able to work, or we will be spending relaxed time with our grandchildren and do some minimal leisure activity without stress. So this is how most of the people's lives are going to be. Just think about it, how our life transition from each phases, then will decide how it will affect our later life. What do you do with your money? You save, spend, or invest? Thinking hard will move on. Warren Buffett, he was the richest person in the world, had quoted this: do not save what is left after spending, but spend what is left after saving. Most of the people we do in the opposite way, but we want to try to implement this in our life. So this is a easy step first to how we going to save and how we going to spend the money. This is a graph, like we can plan our monthly salary in this basis. So before starting into a investment journey, the stage one you want to save, then only you can start your investment journey. If you don't have any money left over to invest, then you can't start your investment journey, and you will be on the rat race for the rest of your life. Whatever you earn you spend, and again you go back, earn spend, so this will repeat. Just try to implement this in your life, like spend like if needs is like basic mandate things we're going to have: rent, mortgage, groceries, utility, home loans. And wants is like we do like movies, uh, going out, having dining out, and having some good food. And rest of the 20% we want to save. It is for our retirement and future goals. Like everybody will have a different aspiration for how they want to accumulate the money and spend it on our future goals, like education or marriage or going for a vacation, those things. But how much ever you save more than 20%, it will be great, but ideal minimum at least you want to save 20%. Here it comes the new terminology. Those who doesn't aware inflation, whatever the money you hold will be eaten by this rat, and your money will become off, or sometimes it will be no use also. Just look at the next slide. This is the expense. Consider when you are like 10 years before, the tea which you bought for 5 rupees now it costing you 10 rupees, and from the 10 years next to it, it will be costing around 30 rupees in our future, maybe after 10 years. So that's how all the expenses will be keep on increasing. It is called as inflation. And ideal rate of in Indian inflation, it is like 5 to 6%, but it will be varying drastically. Even like if you consider a country like US, previously it was just 2%, and now it has been around 9%. So it depends on all the macroeconomic factors. What it will do for your saving: consider you have a 1 lakh rupee in your bank account, and you do not do anything with that money, and you just let it be idle for the next 20 years. You see the uh, result, like how this 1 lakh had turned out to be a 35,000. This is what because of the inflation. Your money lose the value of its purchasing power. The maybe like with the 10 rupees you can buy a tea today, but later in the 10 rupees even uh, you can't even buy the tea tea glass, I mean tea paper cup. So that's how the inflation going to be, and it will eat away the purchasing power of your money. So what we can do with that? Here are our life goals. As a human we will be always will craving for this kind of a goals, like getting a car, starting a family, and if you have a kid you want to spend for their education, and also get them married and own house, retire peacefully. And for achieving everything you want a money. And how you going to do all these high ticket items? Only by saving, because you can't spend like 20 lakhs for your child education in the current cost today, just from the 1 month of salary. If you're not saved you want to get a loan for that, and you adding a burden to your child. So just plan it earlier and lead the life peacefully. Let's see how we can plan those things. That's what we're going to discuss in our this session. Our financial life is fall into this pyramid. This is like whatever you money have, you are a very poor person or you are a very rich person, everybody will be aiming for this. Their money will flow into this kind of pyramid. If you are a very poor person, you will be trying to fight the needs, and if you are a middle class person you will be trying to do your wants. And if you like go into a next level of finances you can achieve different things. But everything is like how much you have and how much you have saved. Based on that you're going to have those kind of lifestyle. And when we talk about investing we see there are like multiple options like mutual fund, gold, stocks, real estate, insurance. But we have been pretty much confused which one to choose. But as a Indian we are always we do for gold investing and real estate, irrespective of whatever the returns other investments give, because we are familiar with our neighbors, and yeah, our parents had did the same. But our generation we want to think which will be ideal situation for us, and we want to think need to have kind of a knowledge to choose the right kind of investment instrument for our life. Don't just rely on like traditional way, because in traditionally like 50 years ago we used to go in a bullock cart, uh, and we do only agriculture. But our lifestyle has been changed, we are moved to going in a bike, car, and started using internet. But why still relying on all the like 100-year-old same investment option? Just we want to think about what is the current investment options will be good for us and choose it accordingly. And when we are choosing the investment option, each asset class will have its own risk and rewards. So this is a graph that indicates like cash is what you keep in the bank, and yeah, FD, mutual funds, real estate, peer to peer loan, like you are lending somebody, and direct stock investing. And this alternate investment is what HNIs, high net worth individuals do, that is for F&O trading option. But recently uh, people, because of a lot of YouTube influencers, they started thinking they are straight away getting into this F&O option by taking high risk, and even they lose their capital. So you want to cautious about that, and just think what are the other options you have and choose it accordingly. Just a lack of awareness, we get information bits and pieces here and there, and we started making our investment, but that should not be a case. Risk appetite. Risk appetite is completely based on the personality, family situation, and the age. So the risk of a 30-year-old can take is different from what the 60-year-old can take. Consider your portfolio. And recently people like new investment option like Bitcoin, everyone jumped into it, and now they burned their fingers. This is they doesn't not aware of what is the risk appetite and how much they can lose. If you are like a person with the 1 crore of value, you can just try out some 20,000 in that and see how it goes. But you are a person with just a 1 lakh 1 lakh as your investment, and you try to put the entire amount in the Bitcoin, you lose everything. So you want to decide what is your size and why you want to choose those kind of investment. Because if you are like, it's a mosquito and elephant. If you hit a mosquito, at the same hit it will die. But if you hit a same force in the elephant, it not even have any pain or some feel, because they are in different size. Similar way, our investment portfolios and our assets, everything is different size. We can't compare with our friends, our colleagues, how they are making investment, what their risky bets are there. So we can't just try to copy them and implement in our life, because we can't take the hit as they take. It may kill somebody and it may not impact even a not even a small impact in an elephant. So that's how you want to decide your risk appetite. Some personality says like they are very risk taking, but your family circumstances doesn't allow, it will be a kind of unconditioned. If both personality and family situation allows, you can take a risk, or else you can play a safe game. There is nothing wrong about it. Like you can go a little bit slower instead of reaching the goal very fast. And these are the different type of investor personality: conservative, balanced, aggressive. And the investment instruments also will change. Instrument, what I mean is like equity, gold, uh, debt. It is like our goal is like going for consider you are from traveling from Chennai to Delhi, and Delhi is our goal. We decide based on whether we based on the distance, we can decide whether to go by a car, or by a flight, or by a two wheeler. If our journey is very long, you need to choose a flight. You should not choose a two wheeler. And if you are in Chennai and if you are trying to go within some like less than 10 kilometers, you don't take a flight for that. You will just go by your two wheeler. So based on your goal and timeline, you can decide the investment option accordingly, and you can choose the right instrument. That's what's like equity or bond or gold. And each investment instrument has their own risks. So based on like our risk taking personality, we can choose the more allocation for a bond or gold and less allocation for equity. Or if you are a risk taking personality, we can go for more allocation to the equity and less allocation in the bond. So these are the ideal return one can expect from their investments. If you look at this, it is like around 8% for a conservative. It is, I am saying, like not from a single product. It is like consolidated of having all the products and the giving the returns. You all, whenever you choosing investment, you should not just rely on one product. It is like you want to consider equity little bit, gold, and bond is what the debt product is. And if you look at like for the last 15 years, if you see the equity has given 10%, and this is a foreign equity like US Nasdaq given 15%, bond is whatever similar to FD, it will be given 6.5%, and gold are given 14%. And as we discussed in the early slide, it will be more about a lot of mixture of the bonds and equity. Conservative investor may get 8%, and aggressive may get 12%. It is completely depend on our personality and our choice. and this is how it will, the volatility will be there. Sometimes it will go 18%, sometimes it will be minus 1%, sometimes it will be 6%, 7%. And this volatility is what is called as market risk. Whenever we see the commentary like investment mutual subjected to market risk, please read the offer document carefully. So that is what they say, as it is underlying tied to market is what, and stocks is nothing but a company. Due to corona, if all the companies are shut down, they're not going to make profit. If they're not going to make profit, our investments also, as we are invested in the company, it's not going to make profit, but eventually they will come back. Like all the cinema theater had been open and they started, you know, back to the business and start making profit, and our investment will grow. So that's how, that is what the market and stocks, everything it means. In the first step, we want to think about life insurance before starting any of your investment, whether your family is covered. You want to decide about that. And there are like many policies are there: term, whole life, and also some LIC money back. And you can see each has some different purposes and timeline. You can choose accordingly, but most advisable is to take term plan. And there is a health insurance. If you are working in a corporate company, your company will provide you the health benefits and also some good coverage of life insurance, but you can't just rely completely on the employer. In case of you lose a job and want to trying out for another job for 3 months, in that time if you met any accident or something, then you will be end up paying out of your pocket, and that small time can impact your large in your career, because you don't have a job, and that time you also incur the medical expenses. You can't bear that. So it's always to get a private health insurance. And one more thing is like the premium goes up whenever your age. Like right now in 30 you will take this, and if you go for 40 and that time you take, now it cost you around 15,000. That time it will cost you around 30,000 or 35,000 based on the age. And there is some waiting time for the pre-existing diseases. Like consider you have some kidney stone or something, and you don't in corporate, in our office policy, you will be getting immediate cover. But if you take a private policy, you want to wait for 3 years to get the treatment for the pre-existing disease, or else you want to make a payment from the out of pocket. So sooner the better you can take that coverage. And at least take minimum 5 lakhs coverage if you already have one policy with the employer, or else it's better to take for coverage for 10 lakhs. So once you set with the life insurance and health insurance, somehow these are the risk mitigations. You mitigated some risk in your life. Then you want to accumulate some emergency fund. So this emergency fund will be like how or the expense you include. It can be like minimum of 3 months of your salary, because it will help you on your paying rents or groceries, schools, education, like whatever the children's incur. At least minimum 3 months will be you need to have as emergency fund, and put it aside. You don't disturb that money. Like it is only need to be accessed at the time of emergency. Other times you should not touch that. Tax planning, obviously, if you are like a good paying person and good earning person, sorry, and you will be inquiring tax planning, because all most of the money, as we say once, like the rat is the eater of inflation, and the tax is another outgo of your cash flow. Even you don't do nothing, they will take away and give it to rest of your money to you. So plan your taxes, ATC and ATD, the medical bills and medical insurance, whatever I told you early slide, the medical insurance policy which you have, that you can claim it in the ATD. and home loan interest also you can get it climbed over here. And in the ATC we'll have different instruments. Let's see how much each of them giving and risk. If you look at all the investment option in the ATC investments, we feel ELSS is giving a better return, and there is no guarantee, and lock-in period is 3, and PPF is says 8% and guaranteed return. Yes. So this is how like each product will comes with, there is a trade-off, how much risk you can take, how much return you can get back. The return here they say is like equity risk is what I said, like market risk. There will be ups and downs. If you able to uh, sit tight and hold on this volatility, you can get the higher returns. But you are a very risk averse person and want to be with the always kind of FD kind of instrument, that you don't want to grow your wealth, then you can stick to some other low interest earning products, and you can continue your investments. But mostly at our age, and if you have age also in our favor, it's better to go with the LSS for a 10-year horizon. We can plan our child education or retirement planning. We can use that fund if we're not going to disturb it for 10 years. And this is how the allocation of asset had been done. If you look at some great investors or very rich billionaires portfolio, this is how it will look like. They will be having some part of equity, debt, real estate, gold, cash in their portfolio and growing well. But most of our Indians, it will be just our home, where we stay. That's what we call it as an investment. And gold ornaments we buy for our family members, that's what we call as investment. But that is, we once our home price has appreciated by 50%, we not going to sell our house. And if gold price goes up also, we not going to sell our house. And if it comes down also, we not going to do anything. And this is our personal belongings, so we should not consider it as an investment. Investment is like need to be a kind of financial assets. It can be rebalanced based on the market condition and our financial goals. So that's how we want to plan our investments. And there are two types of investments. There is one, growth in value and generate income. In our early stage, like if you invest in property, buy a land, the land not going to give you back anything, but you just rely on how the value is getting grown. Similar to like gold also, we just owning that precious metal so that the value goes up. Even buying Mona Lisa art or some also same thing. It doesn't have any intrinsic value, but it goes up. In mutual fund also same thing, like underlying it will invest in companies like Infosys or HDFC Bank. And if the business is doing well, our holding of that share or mutual fund value goes up. The income generate thing is what the bonds, PPF, you get the interest back. So in the grow in value properties and all, we not going to get a kind of interest or regular income. But here in the bonds, we will be getting a interest. But these are the product we want to choose based on our age. If you are already a earning person and you want to just morely focused on growth in the value, and if you are in the age of retirement and you doesn't have a income to spend, that time you want to rely on this monthly income generating like either rental income or bond interest income, so that you can live around with those interest incomes. But in your early stage, you need to morely focus on growth in value. So age as most deciding factor in which investment we choose. Just because it provide monthly income, we should not take that in our early age. And mutual fund have both the options, and there are like many varieties are there, like we'll see around in the next slides. So how does mutual fund work? If you look at as an investor, like you, me, and some of friends, like we put in the money, and the fund manager is a guy who did his MBA in finance, CFA, chartered auditor, and he will be managing the fund of securities. Securities are stocks. Stocks is nothing but like as a companies like Google, Infosys, Microsoft, and if the company makes the profit, it will give back to these investors. The investors, that is what it treated as returns, and the returns are given to us like a investor, what we are invested. But if you are like early stage company, and you instead of getting a money back, what happens is that money had been reinvested into that asset itself, so that even the compounding will kicks in, and instead of 100 putting in 100 rupees and getting the 10 rupees back, if you put that 10 rupees back, and that 100 rupees of 10% you get 10% you get 10 rupees, the same 10 rupees you put back into that, in the 110 rupees of 10% you will get 11 rupees. So that's how every year it will be keep on reinvested, and it will grow. The compounding kicks in, and it will make the magic. And this fund manager will be managing like more than 30,000 lakhs of crores of money, and we are taking part of in their community and the economic of scale, which help us to manage our money in the better way, because we have a dedicated person who has knowledge in that, who manage those things. And these are the category of mutual funds, like equity, debt, hybrid, and solution oriented. Others you can ignore. Like under that, there are multiple equities itself. If there are more than 5,000 companies are there, and each company, they will be categorizing into large, mid, and small. The large cap is like top 100 companies, and mid cap is next 100 companies, and rest of like after 250 everything will be a small cap companies. So that's how these values are being set. And sector is like IT, pharma, and ELSS for tax saving. And debt, you have like variety of products. If you look at this, it maybe looks confusing, but it is like how consider like a FD, how you are going to, how long you're going to keep, like 1 year FD, 2 year FD, 5 year FD. Similarly, overnight, like less than 3 months, 1 year, 3 years, more than 5 years. So there are different products, and based on our duration, we want to invest in the debt products. So you need to have some skill to choose those things. And credit risk also, like lending, the banks lending to some companies. So those will have a credit risk. And gilt is what the government bonds, like consider government or national highways the government want to build, they will be issuing a bond, and this bond will be bought by our mutual fund houses or some HNIs, high net worth individuals, like who have a lot of money, and they can buy, and they can fund government projects. For that, government will pay back in like 7% or 5% interest to that. So that's how there are like variety of bonds are there. And hybrid is what mixer of both this equity and debt products, like there will be 70-30 mix and 50-50 mix, and those things are there. Solution oriented is like based on like time duration is 20 years or 30 years, you can choose those kind of funds. And if you look at this risk profile and tax friendliness, each low risk and high risk category had been boxed out, and your time period also given there, like how many years you want to hold that investment to get those return. Like even like there is, if you consider animals, each animal will have some pregnancy duration, like it may be 4 months for a dog, or 10 months for a human, and 2 years time for a elephant. So each animal comes with each pregnancy period and to get the baby delivered. Similar way, like our returns, each period will have we want to hold something to get a positive outlook of that baby. So that's how our investment also we want to look. If you are try to pull that in the early stage, you may be getting in the negative returns. So you want to choose ideally where we are getting engaged and how long we want to wait, and based on the duration we want to take the action. If you're trying to do something other way around, then we don't expect the result which we they were shown in this. And if you look at this is a Nifty 50 is what like India's top 50 companies, how it is performing, like all the TCS, Infosys, HDFC Bank, ITSC, Hindustan Unilever, everything will be a composure of this 50. And you look at this period of like last 25 years, it has like ups and downs. If you look, there is a Kargil war, and after 2000 bubble crash, and 2008 financial global financial crash, and there are like many crashes will be there. GST implementation, there is some downturn, demonetization. So whenever there is some unrest in the society, and even see corona, there is a sharp fall. And now like in 2022 it was in it is 16,000, now it is around like nearing 18,000 is the point right now. If you look at this, every time there is ups and downs. When from here if you see this is a fall, but later time you see it has been grown over in the long period of time. So whenever we hold it for a long time duration, our investment will grow back. But if you get scared, like consider corona time, and it has fallen like 30%, and you scared and you got out at this time, then you lose our investment. What actually you want to do is, whenever the market goes down, we want to invest more, so that we can take part in the upward journey. Look at this journey. So but if you do other way around, then you will be losing your money. That's how you want to have some courage to take part in this long journey. But in the similar way, if you, even people are very keen on buying real estate, if you have some exact metrics for a land purchase with this kind of a graph, people even get scared to buy real estate also. But we don't have this many datas in that area. Somehow like lack of data also making some feel to do well. And anchoring price also there. But here we have our data, and we can think about what happened last 25 years, and we can decide what will can happen in the future. And we want to prepare, like you should not be worried like after investing it is gone down. You want to be happy, like you can invest more, and eventually your holding time going to be more than 10 years to 15 years. So at the later of time you will be making some good money on that. And here are the two formulas you want to know, like CAGR versus XIRR. CAGR is like you getting into one investment by paying one time lump sum and getting out in the other way. Like consider like real estate. You buy a land for some 50 lakhs, and you getting out at the value of like 80 lakhs after 5 years. So this is like one time in and one time exit. You can't pay every year some small money, and you can't buy the property. You're paying one lump sum and getting out in the lump sum. So that is what CAGR means. XIRR is like every month or irregular interval, or you pay some small amount, and that amount how it had been accumulated in the long run. So that return will be calculated as consider like you want to pay 10 lakhs, you are not away straight away paying the 10 lakhs, but you are paying like 20,000 on the each month, and accumulating that 10 lakhs in this investment, and how the returns will be. So that's what here it had been calculated. This is a mid cap portfolio. And if you look at this lump sum, somebody invested like lump sum of amount, and at this period of like 3 years they made some 62%, and if they made some like monthly 10,000 or something, and in this duration period they made 70%. And if you look at this period like for 6 years, they may lump sum invested and not made anything, because look at this graph here to here, it is in the same, even below they not made. But SIP person like monthly who invested in the all the ups and downs of done, even though the from the 2008 to 14 the market doesn't go anywhere, but this SIP guys who disciplinedly invested every month made like 15% return. So here is the catch. So instead of like lump sum, if you make SIP every month, even in the market is not doing very well time also, you will make some good money. And this you can look at all these different time frames how this had been happened, but this is a time frame for more than like 15 years, and this lump sum had given 15% and SIP had given 14%. So that's how, like if you're able to hold it for 15 years, you no need to worry about all these ups and downs. You just focus on your work and our career development. This investment will automatically will grow at the time when we need for a college education for our child, or marriage, or even for our retirement. We can take that amount and we can start using it. We should not worry about all these ups and downs and get scared. So you want to develop that skin, thick skin in the investment journey. If you are new to this, you want to develop this, that's it. The psychologically you want to be stronger, because you have a data, and from the data you can look at it. This is what happened like last 15 years or like 17 years. Power of compounding is what is most of the people will realize later. We are in the midway, like everybody is okay. You want to take a break, just grab a coffee or something and listen to it again. This is the interesting part. Like we are, how early we start, how what benefit we going to get. If you start your investment journey at the 25 and you invested like 1,000 rupees per month for just like some 8% return till at the age of 60, you able to see we are invested around like 4,20,000. Okay, that value had been become 23 lakhs. Just think about like we now instead of not started at 30, like 25 we started at 30, how much we saved and what is the value had given. And we missed everything, and we started realizing at the age of 40, oh god, what I did with my earnings. I do anything? I not did anything. Okay, let me start investing from now. Then that you will be having very less runway. You what you will make will be like 2,40,000. You will be making. How much the value of that amount can become? Only 5 lakhs. See, around 6 nearing 6 lakhs. That's it. But the person who started at the 25, look at how much he accumulated. So that is what the power of compounding is. The earlier you start and the time is in our favor, we want to take advantage of it. Returns is completely depends on market. We can't do anything about that. How if it is like kind of a rain only. If it rains, we can harvest and we can make some cultivate some good crop. If it doesn't, we can't do anything. So similar way, but what is in our control? In our control, there are two things are there. One is how much we can invest, and another is age, how long we can wait for till our retirement. So if we have these two things, and we don't need to worry much about the returns, like somehow we can uh, get that corpus at the end of our retirement age. And whenever we talk about retirement retirement, even when I was starting the journey also, I feel like, oh, you want to think about old age and those stuff. But I think about like my parents, like he worked in a government job and he is getting pension, and somehow like at the time of retirement they have some PF contribution, pension loan, lump sum amount came. Using that, it helped for somebody like people to get construct a house, or help them to get their married, they help them for their child marriage. Think about the same thing at our old age. Like we are in a private concern, we don't have any concept called pension and lump sum at the end of our retirement. And what action we took, whether we forecasted ourselves in the future, and are we future ready. We are somehow, everybody are humans, like we are going to attain 60 age, and after 60 age we may lose our mental capability also. And so that our by the ages, our bodily or analytical skill may come down. But we want to agree that it's not like we that is not going to happen for me. Because no, every human is mortal, so we want to accept that fact and we want to prepare for that. It's not like thinking about those things and getting worried. So we want to face it with a smile, that's it. And this is what dollar cost averaging people used to say, but here is what how the averaging is work. Mutual fund, mostly it will be calculated as NAV. If you buy a share, it will be share price. If you buy a mutual fund, it will be calculated as NAV. Consider you're buying for 10,000 in the rising market, you will be getting 10,000 for 10 units, and same 10,000 like for 14 units. It will depends like how many allotment for here. You say 1,000 units got allotted, when the price is more, you will be getting only half the amount of allotted units. In falling market, with the same money you will be getting more units. See, in the volatile market there is some ups and downs, a swing is there, like this it's going on. You will be getting different kind of units for same 10,000 rupees. And that's what you want to do, like investment like every month without even market up or down, so that it will be average out, and we'll be getting like you can see here average how many units we got. So this is how the discipline is the key, and we can control the volatility. And in this stock market journey, I understand one thing: nobody can time the market, nobody knows when is the peak, when is the bottom, and perfectly getting in at the bottom and perfectly getting out of the top. Nobody can do. Somebody, if he say he can do, just stay away from him. That's what you need to do. See, like how in the Kamal Hassan comedy used to say, somebody say God is there or not, it's not a problem, but someone says I am the God, you want to stay away from him. Similar way, that's why somebody try to say he will time the market, you want to get away from him. Be careful on that. Nobody can do it. If they can do it, they might be a richest person in the world. And these are the small different categories of fund and how it had been performed and given the return. If you look at in 2000, from 2012 to 2022, somebody started doing 10,000 SIP per year, and they may be invested 12 lakhs. And the CAGR, what I told, it is a lump sum investment. Hmm? If it is a lump sum investment at the 2012, it may be given like more than a crore, 1 crore 22 lakhs or something. And if they did, instead of lump sum, they did every year 10,000, it will be XIRR, and it will given around 44 lakhs. So this is how the lump sum and monthly investing work. But look at the value anyhow. Even like 12 lakhs investment getting 44 lakhs, it is like around 4 times of its value. The money had become 4 times in the period of how many years? Let's say like 10 years. It's a very big 26%. It is, this is what top performing fund. We should not whenever we say this kind of high number, we should not think like, oh, we're going to make this kind of money for rest of our life. No, this is something in the backtracking, it looks good. And the small cap funds and all, like very risky. The volatility, like if a large cap fallen like 20%, small cap will fall like more than 60%. So that kind of volatility will be there. If you're able to cushion that, then you can reap the rewards, or else you just stay with some mid cap or large cap stocks, and even with the lesser volatility you can make some decent return. But these are the like top performing, how much mutual fund can deliver. That's what we seen here in the past, and we can have some idea like how each category like small cap, mid cap, and funds and those things, how it had been performed and delivered this 26% return. Like if you are running a business, how much margin you will run and operate, like more like 20% or 30% you want to get in and do all the operational work and make those in and you want to invest in a shop. Like if you want to at least to do a grocery shop, you want to have at least minimum 5 lakhs or 10 lakhs investment, and calculate the return on investment on that. Here it is working parallelly. We are not we just choosing the fund and doing monthly contribution to it, and we reaping the rewards instead of we running our own business and generating the value. So that's what the one advantage. You have been taking part of Infosys, so Narayana Murthy is working for you in the way like to generate good returns. Asset allocation, I said there is a volatility, right? Ups and downs, and similar way like each year different asset will perform differently. Consider in 2012 the mid cap had given 38% return, the large cap 25%, and if your T-bills is what the government uh, bonds that had given 6%. If you see the from the 2012 to 2021, the top performers are not constant. One time it is a mid cap fund, one time it is a US funds like international small cap, and credit risk is a bond, and government bonds are given 15%. Small cap gold at C 8%, and next year is international small cap, and they perform mostly also. Like if you look at this, gold is given minus 8%, small cap is given minus 23%, real estate is done 120%. This real estate is like if you go to Brookfield Mall, Phoenix Mall, some companies in Bangalore or tech companies, mostly they everything is not owned by a single person. It will be a real estate company like Brookfields and some other real estate agency. They will be pooling the money and buying those property and giving back the dividends to the investor. So that's what the real estate is. Offline real estate, only people doing want to sell, they will sell. It is going in good price, so we can't rely on that. Only data, we want to rely on data says, we trust. That's it. See, from this chart you can get a clear understanding how each asset class and each category is performed, ups and downs. Nothing will be giving you constantly return every time. So at every duration, one thing will do well, another thing won't do well. So consider like even gold, 2020 it given 27%, and 2021 it had given minus 1.5%. So this is how it will be, and nobody can time or nobody can predict what will do next. Only we can say in the long run what will do well. One prediction for 1 or 2 years or 3 years and all, nobody can do it. In the long run we can predict it, how it's going to be. That's what you can do in this investing journey. In the investing, how we can invest in the mutual fund is like do a lump sum. SIP is what systematic investment plan. Like every month second you will be investing, and you decided it and you will do it for next 10 years. That's how. But that is what system, you putting a system in a place and making a disciplined investment. If you want to do manually, then you won't get the discipline. You are humans, are we tend to error prone, and we will we may missed out those payments, and that's why SAP is the best option. We have a discipline. And prismatic transfer plan is, as I showed in the earlier charts, like putting a lump sum into a equity. It may do in a result in the positive way, also sometimes it won't do in the better returns. What we can do is we can park that money in the debt fund. Consider you have a 10 lakhs, just park that money in the debt fund. In the debt fund you will be earning around like 5 to 6% of interest, and slowly, like 30,000 in a monthly, you can move to equities, so that you can average out and you can slowly dilute your lump sum money into a equity market. And from there also you can earn the return, and the money whichever, like 10 lakhs remaining amount also, it will be earning the interest. So that's what systematic transfer plan is. And there is a inter scheme switch. That's what I told, like debt and equity you can change based on the market volatility. So consider, like you we want to always need to have a debt portfolio, because market whenever it drops, you want to have some money to buy more. If you have some money in a debt, then you can pull that money and you can buy more equity when the market drops. So that's what the major advantages. And this intra switching option will help you to do that. Whenever I talked something about what is investing and what is trading, people doesn't know what is the difference. Like even I come across, like I thought like trader was the actually investors. Then only I come to know they are just a gamblers, and they just bet on something very short term, and whether it's going up or down, like tossing the coin and say head or tail. That is what they do. And for that they can say like some technicals and looking some volatility graphs. But as an investor who have a long term vision, we will be only focusing on long term goals, like how whether our goals are met or not. We are not here for to make a quick money. If you want to do a quick money, and you will be losing your capital, and maybe you become bankruptcy. If you watch the Wolf of Wall Street, and like Arshad Mehta, those are the examples of traders. So how it will be, even you can do a quite well for a few years, but in the long run it is very hard to make the successful. Even the founder of Zerodha said like only 1% of the traders who do make profit more than 5% of the FD. That too only 5% of the FD returns. Then if you see like 99% people are losing the money. Why you want to take part of some, you clearly know you're going to lose the money, and why you want to get involved in that? If you believe you are that 1%, 1% going to be that superstar, or like kind of a cinema industry 1% successor like Rajinikanth, you can try option. Or else just stay away from that, and just choose a mutual fund and do a SAP. Like 15% return is a very good return for a long term. Like if you look at Warren Buffett, I will show you a graph of his wealth, how he accumulated it. Look at this. Look at this graph of how his age and how his wealth had grown, and he become a richest person. In early 14, he has just 5k. He started investing in the age of 14. Oh god, okay. And from there, if you look at all at the age of 83, it till 40 till his 50s itself, I feel there very little the graph, but it is moving, like it is doubling every year, but that is not happening exponentially. And later point of his age, if you see the graph had double. That's what the compound interest will do in investing. How much ever the money you have, it will be grown very fast. In the earliest stage, even there is one Chinese bamboo tree. Like initial 5 years, you don't see the tree is growing at all, and within a 1.5 month or 2 months, You see the tree will grow to 20 feet. It is a Chinese bamboo. Even you can Google and see, and you can read about the tree. It is very interesting. That's how the investing is work. You won't see 80% of the time. You see it will be stagnant and you will be same in the slow boat. And later in the 20% of time, it will just spike up. So what we want to do is we want to hold it for a long time. Then only we can see the magic and you can reap the rewards. Or else you just getting in and just few years, like for initial 5 years itself, you see I don't see any growth. Then you get out of it. Then you lose all the benefit. You are here it for a longer run. You want to always have that in your mind. You are here it for a long term game, not for to make some quick money. Or what you do, either you are spending some good money and you are living your life, and you are just saving it for a long term. Let it grow. Why you want to disturb it? Yeah. Here here was the few other investment things we want to clarify. Like most of the people who took LIC, and they think it's a two-in-one product. You get insurance and investment, but actually it don't serve both the purpose. You will be like getting a very low coverage for life. Consider in ideal middle class life, you will be spending 50,000 as an expense. And you want to, in the absence of you want a family to survive and meet out their education, and if the child want to grow up for 20 years, at least you need to have some 50 lakhs to 1 crore policy. Then only in the absence of view it will be helpful for your family. Just getting like 10 lakhs or 15 lakhs as a cover, it not going to help you. You can have it for a namesake, but it not going to make any financial, like it not going to replace you. So that's what actually it does. And early stage it's fine. People who doesn't have the investment knowledge to start the investment journey, they can get that and have some lock-in period, so that even you paid for 1 year, and if you want to get out, you won't get your money back. So at least if I think we want to hold at least 3 or 5 years at least to get some partial money back. So that's how it is very tight policy. And giving some, maybe like people who lack of discipline to have a commitment, maybe they build the system. Yeah, it is good one for all the for early stage people who doesn't know anything about investing. It's a good product. But if you gain the knowledge about what are the other products you have, then you want to explore other things also. You should not how we can say, like, you can't still ride the bullet cart itself. You want to move to car. So that's what the new age investment says. And if you look at this return, this is one of my wife's policy. And I just calculated the premium, how much the minus 62,000 is, like out of going out of my hand. And like 5 years once they giving some 1,60,000 something. And if you calculate this return, so this is calculated by XIRR. So every year money goes out and it comes in. You can calculate XIRR formula. It gives like 4% interest, and cover is also like 20,000. But if you pay this similar 62,000, like if you want a 1 crore life cover, you will get it just for monthly 1,500 rupees. 1 crore life cover. For getting see, for a 20 lakhs cover, you are paying around 5,000. If you're 62,000, you are paying around 5,000 per month. And also the return also, like, not even the FD I think they're giving around 5.5%, but it is even lesser than FD, 4%. You want to know about all these things, like, and decide accordingly. Even if you ask LIC agent to do this, I doubt so. They won't explain you with this kind of like Excel model. You can ask them also. Otherwise, if you want to think I am showing a wrong data, you can cross check with them. Why not real estate? So real estate is a good thing, like most of our parents and everybody made their wealth by real estate. And it is a good, but it required a lump sum investment and lack of liquidity. If you want to, you buy a property, and if you want decide to just want to decide to sell for your son's college education or daughter's marriage, and you people know who you are in the urge of selling, they will be demanding lower price from you because they know like you're going to sell anyway. And that's how you will be getting lower price, and the lack of liquidity, selling will be hard. It's not like just a click of a button away. It will take some few months, like 6 months, to close the deal, and also all the lot of legal issues will be there, and lot of hustles are involved in selling process. And the price also, it depends on lot of factors, like you just whether any bus stand is coming nearby, or airport is coming nearby, and any industrial is getting developed, or if any project about to come had been changed to some different location. So you can't predict those things. And like if you're buying a house also, like getting a rent and maintaining, doing a regular maintenance, it will eat away whatever the rent we get. And nowadays the tax for house tax also gone up, and house tax and paying all the maintenance. If you look at, like if you buy a property of like 50 lakhs and you get a rent of 10,000, it is a rental yield of like 2%, 2.5%. Like most of the property around, like everywhere in India, that's what this case is. You will be getting whatever the amount you put, you will be getting around like 2.5% as the return. It is even lesser than FD, whatever the yield rental income we have. Even if you put that same 50 lakhs in a FD, you will be getting somehow higher interest on that. That's how the real estate is on. Only we want to rely on the price appreciation. That's how we make money in the real estate, not in the rental income. And the price also vary. You want to need to be negotiable. One person will say one price and another person will say another, and it's hard to discover what is the right price for the property. So that is the issues in the real estate. Chit fund, yeah, mostly like people in the kind of organize a group and run some chit funds, like paying monthly 5,000 or 10,000, and for 20 people will gather to go together and run some fund. Here what's the problem is, like the counterparty risk. Even the person who running the fund may run away, or even the person running the fund may be good, but the parties, like whatever he included, like the 20 people, 5% decided like they are not giving the money back, or the fund going forward will get tougher, and it won't give better returns, and somehow in mid it will collapse. Then that's it, you will lose all the principal also. And reinvestment risk, like consider the fund is running for 3 years, and you don't have any commitment to do the with the money for the 3 years. You monthly you doing paying the for that shit, and after the 3 years you got that money, and you don't have any goals aligned to that. What you going to do with that money? Because you have a money, you plan to buy something. That's how it will happen. It's not aligned to your goal. People, like spending money is like our natural instinct. It is not we are going out of our instinct and doing the activity. It is like having a laddu in front of us, and it is saying no to eat. Obviously we can spend that money. Spending money is not a big deal. Like saving, it is what we want to do against our nature, and persist our, like resist our willingness, and want to commit to have a discipline. So that is what the real problem is. And low liquidity. So if you in some emergency, and if you want to get the money now, even they said like there will be you can't say you will be getting that term. Consider next month you want, you can't. It will be completely based on the auction, and you may not get that opportunity to get your money back. So that you maybe need to wait few more months to get that back. and that is a liquidity issue also there. And that's the reason you want to decide for your life whether it is work. You are a working professional. If you want to take a loan, you can just approach a bank and get it for like 10%, even lesser rate of interest in the bank itself. And for investment, you can choose the investment products. This two-in-one products and all, it's like for unorganized sectors, people who are lack of any investment knowledge to have some discipline. Though for that, this kind of instrument had been built. So when we evolve, we want to we want to like move on to next products. That's what I see like even these are the products, even still it will run and still it going to be there for a few more years also. But you want to decide like what is workout for me. Is this a ideal product for me? So all the questions is very personalized. It is not like generic statement. You accordingly we want to choose the product. And physical gold, you see, if you buy a gold, they will be putting some making wastage and it will cost you around 20 percent, and again on top of that GST 3%. And nowadays with the like 1 gram of gold is around nearing 5,000 rupees. Like they wearing that in a train or in a public environment, and missing it may be a very very big risk, like losing a lot of money on that. So we want to be very cautious. Even wearing that is given, we can't very comfortable. So we want to very conscious of whether we might lose it or not. And even we keep it in a home, we want to see is it in a safe place, or how it not is anti-theftable. And we will be always in the psychological pleasure, I mean pressure. So you can have some few ornaments, and rest of the things as an investment perspective you want to think again, because whenever you buy gold, immediately you will lose 20% of its 25% of its value. Then what, how it going to be investment? 25% you're losing immediately, how it going to be an investment? For that 20% itself, like we are struggling to get in that mutual fund for long 15 years, and you are ready to lose immediately 25% in this investment. Then it is not a right uh, instrument for our wealth creation. Yeah, and this investing journey, as I said, our current reality will be here, and our goals will be here, like 15 20 years away. And this is not going to be a straight line. As I showed in that chart, it will be ups and downs, ups and downs. You want to be emotionally stable, and you know where we are heading. And even we change, like we want to discuss with your advisor and just make sure like we are in right track, and you don't lose your hope and trying to jump boat in the midway. You want to always want to believe and trust the process, and you want to go ahead. So that's how major of most of the things had been done. You want to trust the process. Even consider like you want to become a, like you completed a college, like, but you after 12th also somebody started earning 30,000 in a Zomato, or driving a Ola car. You say like after my college also I going to get if I joined like TCS I going to get 30,000 as a salary. And what the point of doing 4 years and getting the same, who completed 12th are getting the same, and I after engineering also I'm getting the same. It's not about that. How your career going to be after the initial stage may be same, but the progression of your career may be after 5 years you may be end up with 1 lakh salary. But if you see the same person who do this odd jobs, they are very maybe their growth had been like 35,000. From 30,000 35,000 or 40,000 may go. So that's what the process. So you trusted the educational process and you believed like, okay, somehow in future I going to, it will be rewarding me, and you studied it similar way. Sometimes even you don't see the rewards immediately, but you want to, sometimes you trust the process and stick around to gain the returns. Financial advisor can help you on insurance estimated, like you see, like each person lives based on their current circumstances. Some person may have a housing loan, some person may have a girl child and want to have with no saving, they want to get married. Like whether all this factor we want to include, and it will be very personalized, and we want to estimate for each and individual person. So it is not like a generic term, it one size fit all solution. So advisor can help you on estimating that right amount, how much coverage you need for your life, and how much health cover you want to need based on your health conditions and your habits. And goal based planning, the like each person will have different goals. Like some person want to buy a house, some person want to get retired early, and someone want to uh, go for higher studies. So like, and every person's like need is individual, and based on like time frame they can provide a perfect plan to reach the goal on time, and funds also available at the right moment. And tax planning effectively saving you taxes, and like planning your instead of everything going out of your hand and figuring out later, you will be planning advanced and make the investment journey earlier. Or else if you decide in the hurry burry at the time of tax filing you want to make some investment in the ATC, suddenly for you guys LIC agents will appear and you will be getting some policy with them, and or you approach a bank. And one thing, like, never approach a bank. They will be selling you the ULIP policies, so they will be telling you like you they have a dedicated relationship manager, and they will be helping you on the investment. So whenever you go to a bank they will be trying to sell their products. So that's how the option will work. Like they won't give you a generic advice, where they don't think like what is suitable for you for your needs, because they consider you are a non-vegetarian, and if you go to some vegetarian hotel and if you ask they will try to sell you some paneer only, they're not going to sell you chicken. And they will say veg is good for your health only. That's how it will operate. They won't understand your big picture and different products. So we want to choose the different products based on our personal need. And investment recommendation, so investment recommendation is what if in the throughout the session you see there are like mutual fund itself, there are around 1500 mutual funds are there, stocks are around 5000 stocks. In real estate it is completely depends on place and people from whom you buy, and all the legal issues like how old the document is, how many hires are there, or everything had been properly set up, legal things need to be checked. And you want to choose right investment for your journey, for how your goal is in the 5 years or it is in the 30 years away, and whether you want to reach that goal for sure, or it is like buying a car. Even yeah, if it is doing good I can buy it, or else it's fine. Those kind of priority, based on that we can suggest investment. And estate planning is like you are around like a old person and want to know how to properly segregate the properties to your children's. We will be helping you on the will, writing a will, and plan your investment and just transfer to the next generation properly without having some internal conflict with them, by having everything in the proper place by writing a will. So that's what the estate planning is. And guide you in the market volatility, because you have some go-to person, like you can get some what is happening in the market currently, and why the decision we made this thing, and is that right decision. Okay, that's what somebody to support you morally, and how uh, just make sure this is our plan, this is what we are going on, just hold the seat tightly. So that's what uh, will help you on the guidance. And set the priorities of like getting a life insurance, emergency. These are the priorities. In the early slides we gone through all those things, but top priority you want to plan these things: insurance first, emergency fund, plan your taxes, retirement planning, and children's education, marriage. Why I put retirement planning before children's education is like, even for education you can get a loan, or marriage, that's fine, whatever money you have you can plan accordingly. But retirement, you obviously you're going to attain 60 years, and you're going to have some, when you don't have income you want some money to spend. Either you want to rely on your children's, I don't know, like after 30 years how it going to be. But even in the current generation itself you can see how it is happening around you. You can look around the peoples and decide. So that's how you can plan your life better. Just don't rely on them and put a pressure on them. That's what ideally a person who has some better insights will do. Just try to do that. That's why on for planning retirement you can't take a loan. People only less than 40 years or 50, at least 50 I think somebody give, but nobody will go give loan if you are a old age person, because they will think like, how do you repay? That's what the major concept. You can say whatever you will repay in those things, but how you can repay? You don't have a job and you don't have earning potential, how you can repay? So that's the major factor. That's the reason you want to plan your retirement first, then these two things, because you can't take a loan on that. Yeah, how it will be planning is like, they identify your goal. How financial planning will start with, they will identify the goal and analyze the risk. Like I showed you that mosquito elephant analogy, right? How, what is your risk appetite, and time frame, whether it is like 5 years away or 10 years or 20 years away. And choosing the product, whether equity will be suitable for you or debt product will be suitable for you, because there are like lot of products are there, so each product will be suitable for each person's need and to attain their goal. A goal is maybe like buying a house or education, those things. This is how your life, the left hand side, how it is, it will be messy, like all the things were here and there unorganized. With the plan everything will be organized, and you confidently can face your future, like this is how you are approaching your life and this is how it is going. This is the sample financial planning, how it going to look like. This is a sample. Consider we are assuming inflation will be for 7%, and education inflation is always higher than normal inflation. This will be 10%. Inflation is what I said, right? The tea which cost 5 rupees for a few years back, now it is 10 rupees. Similar way, the same thing will go on for next 10 years and after 20 years also. And the ideal return for equity will be 12, and debt products will be 8. With that, see here they saying like, there is a goal in next 15 years. Doctors education is there, like in 15 years, from 15 years the duration. Present cost is like 18 lakhs. Consider you doing engineering from some normal college, it will cost you 5 lakhs in our generation time itself. And if you're doing some IIT and all, it will cost you 20 lakhs now. From 15 years now, it will be the same education will going to cost you 75 lakhs. That is due to the inflation. We can't avoid it, somehow it's going to be happen. And even some the same thing for we present, we will be calculating. If we do some small recent marriage, you know how much it will be just costing for all the decoration, photography and gold we're going to buy. It will be buying some 20 lakhs if it is happening. From after 23 years, it will be cost you around 1 crore. And same for the retirement life also. If you are spending monthly 1.3 lakhs as a expense, uh, giving a rent for a house, or even education and entertainment, fuel for a car, maid if you keep a maid, for cooking, driver, and those expenses, like if you are getting older and all your medical expenses also will increase, you think like, okay, somehow education expense is not there, so some money will you get saved, but what happens is that that money will be replaced with your medical expenses. So that's what happen in your old age. And see, if you with this 1 lakh spending for a month, it will be costing around 3 crores in current trend. In future of 22 years, it will be costing around 15 crores. This is how it going to be. So just to be forecasting your future and letting you know, like mostly all the normal human, our life will fit into this bucket. Like maybe you are unmarried person, or like going to live like a some uh, a different kind of lifestyle, then no need to plan. But if you are a normal human being, mostly in for 99% people will fit in this category. So, and based on that, like consider there is a color one is given, right, color coded for 15 years. These funds had been recommended. As of now, he is investing this one this much, and just try to add, so far this much had been invested, and the existing SAP is ongoing this one. And financial advisor like planner, I can recommend you like what additional fund you can invest on that, and what fund you can stop investing. So that's how the financial planner will do, and see how whether with this rate of in SIP, and the amount for 75 lakhs, how within 15 years we can reachable or not. So based on your risk appetite, we'll choose those kind of a product. And similar to for a second, there are some few funds had been recommended, and retirement there are few funds had been recommended. And all this NPS, if you are in government sector, NPS will be there, and provident fund in the private field sector, it will be there. That will be considered as a kind of debt product with a low risk, low returns. And somehow that is not alone sufficient for you to lead your retirement life. You want to accumulate some other savings also, then only it will be ideal cover. See, currently yes 42 lakhs, but is see how many needs he want. If you want kind of a lifestyle, la, like movie, want to have lifetime settlement, he want at least some 15 crores, 16, some 17 crores. If you do if he got now, he will get lifetime settlement, lifetime settlement. And he can set rest his life happily without doing anything. That's what lifetime settlement means. Even Vikram Veda movie, sorry, Vikram movie, they Surya used to say, right, that one. Yeah, thank you for attending the session. Happy investing. So you, I have shown you like many slides. Just if you want to go back and pause few slides and look back, think again. And if you want any suggestions, recommendations, or you want to start your investment journey, just let me know. I can help you on that. Thank you. Bye bye.